I want to ask you a couple questions now about central banks, what's going on with the economy. So, when the Fed, the US central bank, first raised interest rates, most people said, no chance this is going to stick. We're not raising rates and not for long. And they kept raising and kept raising and kept raising. And now we're at 5% or maybe even more interest rates. And most people would have said, okay, if the Fed raises rates to 5%, you might as well just light the economy on fire because there's no way that puppy's going to survive. And yet, when you look, unemployment remains low, inflation kind of falling, going back to where central banks want inflation to be. Most people would have not predicted this. They would have said there's going to be massive losses. So, Bob, first, did you predict that there was going to be kind of a blow up event? And if so, how did we kind of get to where we are now?
Well, I think if we go back almost exactly a year ago, there were a number of different sort of classic models that suggested that there was, I believe the words were 100% probability of recession to occur over the subsequent 12 months. And I think, a small subset of us, myself included, looked at the economy, looked and understood the fundamental dynamics of the economy and said this cycle will likely end in a recession environment. And that is probably likely what is necessary to bring inflation durably back to the Fed's mandate. But it's going to take a lot longer than most people expect. And the reason why that is, it's a very important reason, is that the US economy really was fundamentally restructured both following the global financial crisis to reduce leverage in the economy, which reduced its sensitivity to shifts in short end rates. And then on top of it, the period of very, very low interest rates for a very long time and the money creation that came with it meant that basically all households who were borrowers were able to lock in, 2 or 3% yields for 30 years. And nearly every corporate was able to do the same. And so the reality is, like, the Fed is moving the short rate, which we're all familiar with. But if you're a homeowner right now, right, and you're living in your house and paying your mortgage, interest rates could be 10%. They could be 20%. Doesn't make any difference to that mortgage payment. And so that reduced the lever that that meant that the short-term interest rate impact was going to be a lot less than many people expected. Now, that's not to say that there'll never be a recession or that the Fed's tightening of monetary policy won't have any effect. It certainly has had some moderate effect in terms of slowing down the economy and incremental credit borrowing, right? Because incremental credit borrowing is at a higher rate than what the past credit borrowing was. But those sorts of dynamics, they take time to flow through. People have to basically spend down their elevated cash piles. Businesses that are loss making have to spend down their savings. Eventually, they then become borrowers, and eventually that interest rate is too high, and eventually it curtails activity, increases defaults. But that's the sort of thing that what we're seeing is playing out over the course of a few years, not 6 or 9 months.